Good morning, everybody. My name is Neil Billyard. I'm the National Head of Tax here at BDO. People are joining at a rapid rate. I might just give them another 30 seconds, but I don't want to wait too long. Obviously, we need to start pretty close to time, and if people miss the start, they'll have to watch the video. We'll just give them about 30 seconds and then we'll kick off. Okay, we might kick off, and the people that are a bit late will just have to watch the video. As I mentioned a minute ago, my name's Neil Billyard. I'm the National Head of Tax here at BDO. Before I start, I would just like to acknowledge that I'm hosting this webinar on the lands of the Gadigal people of the Eora Nation, the traditional custodians of this land, and pay my respects to their elders, both past and present. I also acknowledge the traditional custodians of the various lands on which you are all working today, and pay my respects to any Aboriginal or Torres Islander people joining us online today. So, kicking off our webinar on the federal budget. Okay. In terms of some of the housekeeping things, I don't know if you saw that at the very start, but just very quickly, there is a tab on your screen where you can ask questions. We did have some questions before the webinar, so we will definitely address those at the end, and any more that come through, we'll make an effort to address as many of those as possible. If you do have technical difficulties, there's an access support button, although hopefully, given that you're already on this call, you've worked out the technology. But that is there to support you if you need it. And at the end of the session, what we'll also do is we'll shoot all of you an email, which will not only give you a copy of the slides themselves and a recording of what we talk about, but contact details for the actual speakers. So please feel free to reach out and contact those people as appropriate. Okay, moving forward. Sorry, I've got to get the technology right. Okay. So firstly, I might just start with my view of what I saw in the budget, and then I'll get some of our BDO experts to go into a little bit more detail. Firstly, I think it's important to acknowledge that this is the first budget following a federal election, so there's certain commitments and promises that were made in that election that need to be dealt with. It is a budget being handed down during a period of the highest inflation that a number of people on this call will remember. I'm a little bit older. I can remember inflation higher than this, but for a lot of people, the inflation number is a big number and certainly focus of government. And that brings with it a lot of issues around cost of living pressure and the like. So what I saw at the budget on Tuesday was really the government trying to set the agenda, focus on the big picture, focus on the direction of where they want to go during this term of government. What was very noticeable was that there was a fair bit of money being thrown at the tax office, and the government seems to think they're going to get a pretty good return on that investment. So I expect we'll spend more time talking to the tax office. We did see a number of measures dealing with multinationals, and we'll talk about that in a bit more detail in a minute. Not surprising, it's consistent with a lot of the stuff we're seeing coming out of the OECD. Cost of living, as I mentioned earlier, that's certainly in the media and a real focus at the moment. I wouldn't say the government did a lot in that space, but there are a couple of things. What they did more than anything else is probably refocus the spending, and that aligns with that sort of earlier comment that this is all about setting the agenda and the direction. If you listen to the interviews of Dr. Chalmers over the last couple of days, he keeps talking about wanting to have a conversation. I suspect what he's doing is he's setting us up for a whole lot more stuff in the May 2023 budget. I expect there'll be something around the stage 3 tax cuts. And if I was a betting person, which I'm not, I would say they're probably going to be scaled back, but May 2023 is probably the timing. We'll hear a bit more on that. And I suspect we might see a bit of a sugar hit, a few more handouts in the next budget than what we saw in this one. What I would love to see, true tax reform. I'm not hearing anything on that, so I will keep making a noise, and hopefully I will see that before the end of my career. But it definitely needs to happen, and it's just a matter of a government being brave enough and bold enough to tackle it and do it properly. In terms of who's going to talk today? So Ali Flint is in our Project and Infrastructure Advisory Group, and she will talk to the economic aspects of the budget. A lot of that stuff is fairly interesting and a bit more detail than some of the tax stuff. And then after Ali talks, James Trainor will talk about some of the individual and employment related tax issues coming out of the budget. And lastly, David Blake will talk about both corporate tax changes, but also some of the international tax changes as well. So just moving on, the things that these guys will talk about. The first three items, Ali Flint will talk about that in the context of responsible budget, limited cost of living stuff, and we continually hear the reference to stronger, more resilient, more modern economies. So I'll be really interested to hear Ali's comments in relation to that. I did mention there's no reference to stage 3 tax cuts. I expect we'll hear more about that in May 2023. James will talk about a tax offset that many of us referred to as the Leamington. It was a temporary offset, which is now being removed. So people will probably rightly view that as an increase in taxes, but I'll let James talk about that a bit more. The international tax stuff, no great surprise, consistent with what's coming out of the OECD, so David will deal with that. And then there's a reference to targeted amendments. What's also interesting is they put out a list of previously announced amendments that they will not be proceeding with. A lot of these amendments were technical corrections to deal with badly drafted and unclear legislation. Maybe the government's being pragmatic and just acknowledging that they don't have enough draftsmen to deal with all the things they want to deal with and fix some of the problems of the past. So I suspect that means we'll continue to deal with vagaries and inconsistencies and lack of clarity in our legislation, which is probably why tax office is going to get more money and we're going to spend more time with them. So probably a good time to get your house in order and work on the assumption that you'll probably be getting a visit from the tax office at some point in time. I'll now hand over to Ali to deal with the economic aspects of the budget, and then James and David will follow and dig a bit deeper into some of the tax changes.
Thank you, Neil. So our economy has performed well post-pandemic off the back of stimulus and higher commodity prices. So as you can see, this is a chart of what our GDP growth looks like. Our economy grew by just under 1% in the June quarter and just under 4% over the financial year. But as we all know, inflation is on the rise and the Reserve Bank has continued to raise the cash rate for 6 consecutive months, with the most recent rise being 250 basis points. We've got strong terms of trade and higher export prices, which have boosted national revenue. But this federal budget has downgraded the economic growth forecast to just 1.5% in the 2023-24 financial year, which is 1 full percentage point lower than the previous budget 6 months ago. The current financial year growth is expected to be 3.25%, and the revised outlook is driven by a slowdown in household consumption amid cost of living pressures. As mentioned, inflation has been rising strongly. We've seen inflation rise above 5% for the first time since 2001, and with the numbers released yesterday, it reached 7.3% over the September quarter, which exceeded expectations. So this means that underlying inflation is well outside the target band of 2 to 3%. The rise has been driven by increasing energy prices, new dwelling construction, and furniture and food prices, and it's the highest result in 30 years. So inflation in the budget is expected to peak later this year, dropping to 3.5% by June 2024, and then 2.5% further out. So the government is expecting inflation to cool over the next 2 years. Our employment, the labour market has strengthened. As we all know, with a tight labour market, the current unemployment rate is sitting at 3.5% nationally, which is the lowest since unemployment data began to be collected in the 70s. So we've had businesses experiencing intense labour shortages, where recently we've had one job seeker for every advertised position. The federal government has addressed labour market pressures in the form of increased migration intake and funding for education. The budget has forecasting unemployment to reach 4.5% by next year, given the influx of skilled migrants, and this translates to 140,000 fewer jobs in the labour market. We've had sluggish wage growth for some time. Wage growth has been picking up slightly, but we are still seeing negative real wages as inflation has picked up at a faster rate. This is partly the reason around the recent caution the Reserve Bank has shown in the latest, more conservative rate rise. Wages are expected to effectively go backwards until 2024-25, when inflation starts to cool, and any gains after that are still expected to be modest. Now, in relation to household spending and savings, Australian households accumulated $240 billion in savings during the pandemic. And as we can see from this graph, consumption has returned to pre-pandemic levels, reflecting pent-up demand. It's largely been driven by spending in travel, retail, and recreation, which includes restaurants and cafes. The retail spending is driven by furniture, clothing, and jewelry. So we have seen with this uptick in spending that the household savings ratio has decreased to 8.7% in the June quarter. So there is a decreasing buffer, which may have assisted households with rising interest rates, but spending growth is expected to slow as the cost of living pressures bite. In relation to the balance sheet, the government budgets have recorded large deficits through the pandemic due to lower tax revenue and substantial fiscal stimulus. But the budgets have, on the other side, benefited from strong commodity prices, which has improved the deficit and debt positions. The outlook is positive for this budget. The deficit is now expected to be half that predicted just 6 months ago in the March budget, which is sitting at $39.6 billion, and most of that gain is expected to come from company tax collections. This budget does address labour market pressures. So during the pandemic, with border closures, our population declined for the first time since World War I during the height of the pandemic, and that resulted in skill shortages and labour market tightening. So to address this, there was a Jobs and Skills Summit held in September, which was a measure introduced by the government to address the shortfall of skilled labour. So as a result, there has been an increase in the migration intake to 195,000 places per annum, up from 160,000, which has been the historic number, and that's expected to alleviate the labour market shortages. But as expected, this does have a downside to it by increasing the unemployment rate, and with an expected job loss of 140,000 jobs. But it will give a boost to the business sector that is reliant on skilled labour. The government has also addressed education and upskilling in this budget. They've dedicated $1.4 billion in funding to boost TAFE and university sectors, with 480,000 fee-free TAFE and vocational education places over 5 years, and 20,000 university places. So the budget is focused on skill shortages in teaching, nursing, and engineering occupations. So in relation to the budget outlook, as we can see here, these are some economic measures that we can track over the next 4 years as the budget's expected. The global economy is facing significant downturns, and some of Australia's largest trading partners are experiencing slowdown in activity. But we're still expecting the economy to grow, so no recession is forecast. This budget hasn't made the inflation problem worse through high spending and placing more pressure on the Reserve Bank to curb inflation, so that is definitely a positive outlook. And the budget has also introduced a focus on well-being, which looks at the impact of the budget on living standards of Australians. So that is a welcome step in modernising the approach of the government to the economy. Thank you.
And I specialise in employment taxes. Budget night was relatively quiet for individuals and employers in relation to their tax obligations. And that'll be evidenced by the fact that my first slide is about things that didn't change in the budget. As touched on by Neil already, the stage 3 tax cuts are already law. So these were enacted by the former Morrison government, and they are due to start on the 1st of July 2024. And the government during the election and since the election has consistently said that they are not looking to repeal these enacted tax changes. But I guess we need to wait and see what happens with the economy and the budget position over the next 12 months or so to see whether they'll stick to that, or as part of the conversation that Dr. Chalmers is intending to have with us, is that perhaps these stage 3 tax cuts need to be scaled back in some form. And just a reminder for the tax cuts, what it'll see is the creation of a really large tax band between $45,000 and $200,000 at 30%. So that's quite a significant change, and particularly for higher income earners, that will see a much lower amount of tax that's being paid by those taxpayers. The other area that we saw no change is the affectionately known Lamington, the low and middle income tax offset. So this is already gone. So it actually finished on the 30th of June 2022. And it is not being extended, and that provided a $1,500 tax offset for low and middle income tax payers. And so this year will be the last year where those taxpayers are seeing an offset come through in their tax return. So as it was mentioned previously by Neil, effectively an increase in taxes for those taxpayers, but there's been no suggestion that that will be extended in the future at all. In relation to individuals and their personal tax compliance, there was an amount set aside set aside for the ATO to extend their tax compliance program as it applies to individuals who aren't engaged in business. And it's not a bad return. If you could get this, I would be very happy to take it. An $80 million extra spend, which is expected to increase tax receipts by $674 million over the next 4 years. So what is this targeting? So if we think about the tax gap analysis that the ATO puts out, individuals who are not engaged in business account for about 36% of total tax revenue. And the ATO reckons it's about 5% and a bit that is missing. So it's about $8 billion tax gap for these particular taxpayers. And it's coming from 2 main areas. One's in relation to overclaiming deductions. And this is primarily work deductions and deductions for rental properties. So those are the 2 areas that we would expect to see the ATO start to focus. In relation to work expenses, it's things where there's employees aren't able to substantiate the expense, or it's not related to their income earning activities, or perhaps that it's private expenditure. So those are the areas where the ATO has some concerns about claiming deductions for work-related expenses. And in relation to rental income, there's a real challenge about the use of property. So where individuals have a second property that might be used for investment purposes for part of the year, but it also happens to sit on a nice beach somewhere so that the taxpayer is actually spending time there. And the ATO is finding when they did an audit of about 300 rental properties, 9 of 10 of those returns were incorrect. And so they're looking at things like apportioning of expenses where there's mixed use of a property, also substantiation of some of those expenses. So we certainly expect to see the ATO focus a lot more of their attention in that sort of space. Working parents also featured in the budget, and this tackles a couple of themes that was mentioned by the government as part of the overall budget. So it's around increasing workforce participation and also about tackling some of the cost of living pressures that individuals face. So in relation to the paid parental leave, this will increase from the current rate of 20 weeks of paid parental leave up to 26 weeks, but it won't happen all at once. It won't happen until the 1st of July 2024, and we'll see 2-week increases over the next 3 years up to 26 weeks, so 6 months worth of paid parental leave. We'll also see more flexible sharing so that rather than having the parent that gave birth being the one that's taking all of the leave, that it can actually be shared between both parents. And unlike it is at the moment, that will able to be taken concurrently. So both parents are able to concurrently take the paid parental leave, and that change will come into effect from the 1st of July 2023. We'll also see some changes to the childcare subsidy. So there will be an increase to the maximum childcare subsidy rate from 85 to 90%, and that applies to families where the household income is no more than $80,000. We'll also see a higher rate available for families who earn up to $530,000. So this is a higher rate and extension. So we'll see more families who are eligible for at least part of the childcare subsidy. And we'll also see the higher rate maintained for families who have multiple children aged under 5 who are in childcare. Now, of course, jumping a little bit on a soapbox in our family, my wife's a preschool teacher, and whilst this is a great policy, one of the great challenges that they're facing is getting staff. So a little bit like was flagged by Ali before, there are challenges in the workforce about getting the right workers into the right roles. So that's still something the government will need to make sure that it's dealing with. Electric cars. Now, again, this is announcements that didn't come out in the budget, but were certainly included as part of the budget papers. So the government is focusing attention on doing what it can to help reduce emissions. And one of these is around electric cars or hydrogen fueled vehicles. And there are 2 concessions that are available. The first is in relation to fringe benefits tax. So one of the challenges that's been faced by employers who want to have their staff driving electric vehicles or hydrogen fueled vehicles is that when the FBT legislation was introduced in 1986, there weren't many of those sorts of cars on the road. They've now become a much bigger part of the vehicle fleet, but the FBT legislation hadn't kept up with them. And so there was actually a disincentive to provide those types of vehicles through a salary packaging arrangement, for example. So what we're seeing here with this proposed legislation, and it's before Senate today, so hopefully we'll see that being passed, is that an FBT exemption will be available for the use of those sorts of vehicles. So those vehicles that are acquired and put into a fleet after the 1st of July 2022, there will be a complete FBT exemption. So that's a really good outcome for employers, and we'll see a reduction in the cost of those sorts of cars as part of a fleet. The other change that we're seeing in that space is a application of a free rate of duty for the importation of those sorts of vehicles, and that's already in place from the 1st of July 2022. It's important to note that for both of these measures, though, it's only for vehicles that are less than the luxury car tax threshold that applies to fuel-efficient vehicles. So it's about $84,000, which means that there are a large number of those vehicles which aren't going to be eligible for this. So just need to be mindful of the cost of those vehicles as to whether the exemption is going to be available for you. Finally, in relation to expatriates, again, not a lot that we saw in this budget around expatriates. 2 things that are worth noting. So for outbound expatriates, there's been a deferral of the proposal to relax the self-managed super fund residency requirements. So initially when this was announced, it was to apply from the 1st of July 2022. And now the changes will only come into play after the legislation has been enacted and received royal assent. What these changes do, it allows an Australian person to spend longer offshore before their self-managed super fund ceases to be a complying fund. So they can stay temporarily offshore for 5 years rather than the current 2 years. The other change for expatriates is in relation to inbounds, and this is really just around trying to make it easier for visas to be processed. So there's going to be some additional funding so that those visas can be processed more quickly, allowing both employers to get offshore staff quicker, as well as for people coming onshore who've got a working type of visa to find themselves in employment sooner. So that's it for the changes for employment taxes and for individuals. And I'll now hand over to David.
Thanks, James. Good morning, everybody. Unlike many of the budgets that have gone before us, there are some tax changes that have some import to people. So today I'm going to go through, and mostly they're in two areas. One is multinationals, and one is in relation to share buybacks. In relation to multinationals, there are three fundamental changes. The first is some changes to thin capitalisation, which involve a replacing of a safe harbour worldwide gearing test, excuse me, with an earnings-based test, which I'll go into in a moment. The second area is denying deductions on payments on intangibles for certain significant global entities. And the third is some improved tax transparency rules. So let's deal with the thin capitalisation changes first, and we'll move to the next slide. The changes are designed to limit an entity's debt-related deductions to 30% of its profits, or in fact, an EBITDA figure. This is a change from allowing interest deductions based on a debt to assets or value of assets basis. It actually reflects a growing global trend. Many OECD nations are now moving away from asset-based thin capitalisation measures to earnings-based thin capitalisation measures. So this is not an unexpected change, although my personal view is that Australia is a large capital importing country, and entities that have volatile earnings will find this change quite significant. And given that the change is commencing for an income year starting after 1 July 2023, there will be some analysis that's required. So analysis of what? Well, deductions for interest are going to be denied where the level of debt deductions exceeds 30% of the EBITDA of the company. So that will mean that it will be important for companies to understand what their forecasted revenues are going to look like, what the volatility in those revenues is going to look like. And given the current budget constraints or the current budget settings, that's going to be a difficult task, and it's something that people will need to pay some attention to. These changes were all forecast in a consultation paper that came out a couple of months ago. And if there was any pleasing result out of the consultation process, it's that there was a general sense, certainly BDO's response suggested that it would be inappropriate, given the volatilities that can occur in earnings, that any denied deductions therefore should be capable of being carried forward and used in a subsequent year. It's pleasing to see that the government has acknowledged that and is allowing the denied deduction amount to be carried forward for up to 15 years. So that takes a little bit of the sting out of the changes, but nonetheless, it's very important to understand your capital structure in light of your forecast earnings going forward. There is a retention of the arm's length debt test, but unlike what many people expected, the arm's length debt test now will only apply to external third-party related debt. So that means that if you've got a mix of internal and external debt, and you exceed the 30% ratio, you can use an arm's length debt test to substantiate your your claim to interest deductions, but only on your external debt, and therefore on your internal debt, there will be a complete denial of that deduction. It's not abundantly clear whether that denial will be capable of being carried forward, but as with most things in these changes, the devil is in the detail. Finally, financial entities will continue to be able to access the existing thin cap rule. So we'll be running a dual thin cap regime for years to come. We might move on to the next slide, which was about payments on intangibles. So significant global entities, which are entities where the global revenue of the economic group exceeds $1 billion, $1 billion A, will no longer be able to claim deductions on payments that are made either directly or indirectly for intangibles that are held in low tax or no tax jurisdictions. And as the slide points out, a tax rate of less than 15%, or where there's a patent box regime that doesn't have sufficient economic substance, that qualifies as a low or no tax regime, and any deductions or any payments made to entities in those jurisdictions for intangibles will be denied a deduction. And you might think, well, that can't be too many companies, but firstly, there are many global entities that have established IP ownership in low tax jurisdictions, and so this will directly impact upon those. And with the falling Australian dollar, $1 billion in Australian revenue now is a significantly lower threshold if you consider a global group's revenue in terms of USD. So I think that this measure will apply to substantially more entities than at first blush one might anticipate. It's not on the slide, but there is also another change for intangibles. The previous government had announced that companies could self-assess the effective life of intangibles. Under the previous rules, intangibles had a defined statutory life of 25 years. The previous government had announced changes to allow companies to self-assess the effective life of IP, which, given the rapid change in intellectual property or the life of intellectual property, made sense. It was announced on Tuesday evening that that capacity is being removed, and it will go back to applying the statutory time periods. The next slide is the third in the changes to multinationals or significant global entities, which is under the banner of improved tax transparency. So significant global entities will now be required to prepare for public release, which is the big change, certain tax information on a country-by-country basis. Currently, they need to provide that information to the tax office as part of their annual compliance reporting. That will now need to be disclosed to the tax office and will be prepared for public release, including a statement on approach to taxation, which is an interesting way to describe what it is that they're looking for. Again, we have no detail about what this means, but and the devil is in the detail, but we are clearly on a road, or the ATO wants to put significant global entities, large Australian listed companies, on a road where their approach to taxation, their payment of taxation, and or their non-payment of taxation is clearly available for public scrutiny. You'll see also on that slide, it mentions that public companies are just to disclose information on the number of subsidiaries and the tax residency of those subsidiaries. This is just amping up the disclosure. And the final piece is the tenderers for Australian government contracts worth more than $200,000 need to disclose their country of tax residence as well. On to the next slide, which is the first, which has a broader impact into the marketplace, which is that off-market share buybacks are now to be aligned, or the tax treatment is to be aligned with on-market share buybacks. And so what does all this mean? Well, we might move to the next slide firstly, but in very simple terms, an off-market share buyback splits the buyback price between an amount for capital and an amount for the dividend. And the amount of the dividend, or the dividend amount, is capable of being franked. So in an off-market share buyback, it's possible to be able to access franking credits where a dividend payment would not otherwise in law be available. So an off-market buyback splits the buyback price between capital and dividend. An on-market buyback, on the other hand, splits the tax outcomes between what happens to the shareholder and what happens to the company. So in an on-market buyback, for the shareholder, the entire receipt is treated as capital. And what that means is that none of it is a dividend, and therefore none of it is capable of being franked. So no franking credits can move from the company to the shareholder. For the company, however, the buyback price is split between capital and dividend, so that there is a wastage of franking credits. And typically that wastage of franking credits is determined in vigorous negotiations between the company and the tax office. But as a general rule, you can expect to see no less than a minimum of 14% of a reduction of the buyback price being treated as a frankable dividend, and therefore creates a wastage of franking credits. So it's clear that the alignment of the off-market buyback and the on-market buyback is designed to ensure that whilst there is a wastage of franking credits, those franking credits don't find their way to the shareholder, who might be either able to get a refund of those franking credits or be able to apply them against other untaxed income, in brackets, superannuation funds. So somewhat ironically, because the government and superannuation funds are relatively strongly aligned, this move is seen as being yet another in a line of changes to limit the impact that access to franking credits will have on the government's capacity to, collect taxes. Finally, on the next slide, there wasn't much in the on the business tax front, but there was there's the self-assessing of effective lives for intangibles. There was also some discussion about the treatment of Bitcoin, and the government reiterated its position that Bitcoin is not a foreign currency, rather it's a capital asset. That just limits the ability of gains and losses, which on foreign currency are taxed on revenue account. So the government is clearly not providing access to that for Bitcoin. My final observation, Neil mentioned very early on that there was some targeted amendments to amendments that previous governments had announced, and that this government was no longer proceeding with. One of the things that amuses me about announced changes and then the amendments that follow those, as a tax professional, we have been sitting back since 2012 waiting for a whole series of consolidation-related amendments that followed clarification that was agreed by both Treasury and by the government as being required. So I would say that there is a long-standing practice of continuing to not followed through on clarifications to the law, which, as a tax professional, we have been sitting back and waiting for many a long year. On that note, Neil, I will pass back to you.
Okay, am I back on? Hang on. Hopefully I'm back on and everyone can hear me. So thank you, Ali, James and David. Hopefully people found that relevant and insightful. There have been a number of questions that have come through, so I might just pick out, there's a couple of themes, so I'll try and wrap them all together, but maybe the first one for Ali, given that she spoke first. There's been a question raised about pressure households and businesses are now beginning to face. Has the budget gone far enough to address these issues? And maybe a subsidiary question sort of related to that is sort of impact on domestic housing market. Do you have a view on those issues, Ali?
So I think that the budget has gone as far as they could to alleviate pressure on households and businesses. For households, this budget has implemented family-friendly measures. So we have cheaper childcare, expanding parental leave, more affordable housing, and getting wages moving again. But the impact won't be immediate, as some of these initiatives will only kick in at around the 18-month mark or the 2-year mark. But certainly the budget has tried not to make, I guess, the current economic problems and the current inflationary problems worse through high spending. On the business side, they've addressed skill shortages through an increased migration intake and education. And with the assistance provided through childcare to increase workforce participation, the increase in paid hours through childcare assistant is estimated to equate to around 37,000 extra full-time workers. So I think that they've done as much as they can to alleviate those pressures. In terms of housing, the centrepiece of the housing spend was the announcement of the National Housing Accord, which is aimed at addressing the supply and affordability of housing, building 1 million new homes over 5 years from 2024. So again, the relief won't be immediate. We'll start seeing the relief kicking in and around the 2-year mark. They've also addressed social and affordable rental incomes through the Housing Australia Future Fund. But aside from that, the budget hasn't specifically addressed rental market issues. Thanks.
Okay, thanks, Ali. I might throw a couple of questions at James now. There was a couple of questions about what wasn't in the budget, actually. In particular, FBT on car parking. It's been a sort of a hot issue around sort of shopping centres and hospitals and the like. So what happened in that space, James?
That's a good point. So the previous government in the budget that they delivered before they lost power had announced that they would make some legislative changes to the definition of what is a commercial car parking station to exclude hospitals and shopping centre car parks, which had historically been excluded. So it meant if you were in a suburban area and you had your car park next to a shopping centre that might have charged a penalty rate, you didn't have to pay FBT on that car parking. Following some court cases and a change in the ATO guidance, those sorts of car parks are now included for FBT, and that's happening for this current FBT year, so from the 1st of April 2023. And we had hoped that perhaps there would be something in the budget to say that there would be some legislative change to restore the world to where it was a few years ago, but we didn't see any of that. So what that means for employers is they need to be careful because there's going to be potentially FBT on car parking for some of those employees who are located in sort of suburban areas, and they need to start budgeting for that because it can be a pretty costly amount of FBT that they need to face.
Okay, great. And now another question. Not sure it's really your area, but you did talk about electric cars, so I'll throw it at you anyway. Question around electric cars in the city being fine, but what happens in rural areas and we need to charge these things?
Yeah, look, that's always been a little bit of a challenge. It's easy to get your car around cities and find a charging station in a local shopping centre or something like that. The government did announce that they'd be putting some more money towards charging stations and hydrogen fuel cell refilling stations along some of the highways and sort of major freight routes. So the government is certainly doing a range of things trying to encourage the take up of these sorts of vehicles. And one of the other things I did notice as well is that they're planning to have the Commonwealth fleet at least 75% low emission vehicles by 2025, I think the year was. So the government's certainly doing a lot to try and encourage the take up of these sorts of vehicles, which will help employers, I think, trying to allow these sorts of vehicles or encourage their employees to take up these vehicles because they'll be more practical in the Australian sense.
So you can charge them in shopping centres, but you don't want to park them near shopping centres, otherwise you'll pay a Okay,
that's a whole other world of hurt. Thank you.
Couple for you, David. I'll start with the easy one and then I'll go with the harder one. Easy one first. The thin cap changes. I don't recall seeing any comment about the $2 million de minimis rule. Did you see anything on that?
No, and one can only assume that remains in place because the changes are to the method by which one calculates a denial, not changes to whether you're in the system or not. But no, you're right. There was no overt nor covert observation about if you're currently not in the system, you'll still not be in the system.
And you would hope that if they were going to change that, they would have said something.
Well, yep. Certainly you would, and secondly, given the substantial increase in interest rates in the last, certainly the last 6 and 12 months, whether you are in or out under that $2 million de minimis threshold is you know, it's likely to be just a function of rate as much as anything else. So yes, you'd like to know.
Yeah. Okay, and the follow-up question on thin cap, David, a reference to EBITDA, question as to whether we're talking accounting or tax, and if it's accounting, do we have to apply accounting standards? And I suppose my add-on part to that question is, I assume in a lot of cases, we're going to have accounting standards that include a whole lot of entities that are not 100% owned, that don't align with our tax consolidated group. So I suspect there's going to be a whole lot of slicing and dicing and recutting and recreating accounting information in order to work out our thin cap position.
Well, I could answer your question / observation, Neil, by simply saying that, like most things, the devil is in the detail, and that's not yet been provided. But putting that to one side, let's assume for the sake of the discussion, excuse me, it is EBITDA calculated on an accounting basis. Then understanding revenue recognition, understanding all the accounting standards and their impact on revenue, as you say, splitting out those things that one equity accounts or less than 100% owned subsidiaries or foreign subsidiaries. There is a substantive amount of, as you describe it, slicing and dicing that will be required, and which is why I think starting the early modelling and understanding what it means for your net outcomes is pretty critical.
And I suppose my add-on observation of that is under the old method that was an asset-based test, when you borrow money, you know what your assets are and it's fairly consistent over time. Whereas once you start looking at a earnings profit test, could bounce around from year to year. So you don't necessarily know that, and a bit hard to model when you borrow money. So
well, it's one of the, this is one of the issues that I've grappled with a bit, which is that Australia is a large capital importing nation. Most of that's typically, you know, you think about infrastructure and large resource projects and alike, and therefore the previous model, which was to assess your debt in relation to your asset base, made sense for a country such as ours. And an EBIT or an earnings basis on, using that rationale, an earnings basis makes a little less sense. But the flip side, of course, is that if you were going off to a bank, very few banks are currently lending based on assets. They're basing, most of it is on cash flow first and an asset backing second. So I could argue out of both sides of my mouth about whether this change is rational and good, but overall, whether I think it's good or bad is not as relevant as each company now needs to actually start doing the modelling about what this might mean for them.
Yeah, I totally agree. I mean, year by year, there's a whole piece of work that has to be done. Okay,
Yeah.
David, you seem to be flavour of the month. There's a question on franking credits. I think it's a bit of a cheeky question, but some of you may recall a previous Labor shadow treasurer put forward some ideas around attacking franking credits, and he's now been assigned a different portfolio. The stuff you mentioned on the off-market buybacks, there's definitely a piece there where franking credits get chewed up and get wasted. So the question is, that the seeds are being sowed in relation to getting rid of franking credits, and any sort of observations as to where you see that going.
Well, even the creator of the imputation system, the venerable former Prime Minister Paul Keating, has expressed concerns about what he perceives as an inappropriate outcomes from franking. I share the concern that says the great benefits that many people have enjoyed through the imputation system look like they're going to be pared back or restricted. There was some announcements a couple of months back, or might have even been only a few weeks back, which also threatened franking credits. Fortunately, no further detail on that in this budget. I think that there is a move to restrict the benefits of franking credits. I'm a little surprised that this move will have an impact on superannuation funds, because one of the great things that the imputation system has done is it has brought superannuation funds and as a consequence most Australians into the share market. I'm not entirely sure why you would want to blow up the capital markets to limit the thing that has brought most people into the share markets. But I suspect that there's a bit of a short-termism that's being looked at here.
Okay, thank you, David. We don't have any more questions unless someone can type one in the next 30 seconds. I think we've covered most of the questions. I can't see any coming through. Okay, so probably a good time to sort of sign off. Thank you everyone for attending. Thank you for Ali, David and James for their contribution. I hope people found it relevant and insightful, notwithstanding that the budget itself was a little bit light on detail. There's no doubt we are living in interesting times, and I expect we'll see a little bit more coming out of the May 2023 budget after we have our conversation with Dr. Chalmers, whatever that might be and whatever format that it takes. What I would note yet again, there's 3 different announcements whereby the tax office is getting more money, and the government seems to expect a pretty good return on that money. So I do expect that we'll see greater scrutiny and discussion with the tax office, and I think now's a great time to make sure your affairs are in order, because you can probably work on the assumption that at some point in time someone will probably ask you some questions. So once again, thank everybody for attending. You will all get an email after this, which will give you not only a copy of the slides and a recording of what we've talked about, but also the contact details of the speakers. So please reach out to those speakers or your normal BDO contact if you have any questions or have after any more detail in relation to the federal budget. Thank you for your time and look forward to seeing you again. Bye-bye.